on the loss absorbing capacity of technical provision. In particular, this is about with profits business. The presentation should last between 45 to 50 minutes, and there will be 10 minutes for questions at the end. So first of all, let me hand over to the chair maybe to say a word. So thank you, Moses Mutuli, for joining. So maybe you can say a word, and then I will introduce myself, and Moses Mutuga will introduce himself, and finally David Limo.
All right, thank you very much, Joseph, for the intro. Yeah, so greatly appreciated. Thanks everyone for actually making time to attend this presentation. Yeah, and to Joseph and the live working party team, yeah, well done. Yeah, for putting together those two papers. Very important. Yeah, that we get proper discussion about these papers today. Yeah, before we make any advancement. To them, to the other stakeholders. So very important that each one of us agree or make recommendations on what changes need to come through before we forge forward with making other stakeholders be aware of what our proposal is to those two matters. Thank you.
Okay, so my name is Joseph Birundu. I am a consultant at the moment. I have around 19 years of work experience. So yes, if that scares you, I mean, yes, being an actuary, you can work for 19 years. So I have 19 years experience. My specialty is mostly life insurance, but I've also worked in general insurance, and I've had a stint doing reinsurance work. I am the chair of the Life Working Party. And so I think we always welcome people to join. So all of you who are on the presentation, please feel free to contact me if you'd like to join. We welcome constructive members who can assist us in driving the profession forward. As Moses said, these papers are meant now to be taken forward, especially the group life pricing paper. And this one, for technical provisions, we will engage with the IRA and see what we can do to improve the regulatory environment. I will now hand over to Moses Mutuga, who will then hand over to David Limo to introduce themselves, and Moses will start the presentation.
Okay, thank you, Joseph. My name is Moses Mutuga. I'm an actuary, I'm a qualified actuary. I work with Sanlam Life. I have about 10 years of experience. My background is mostly around life insurance. I've never worked for any general insurance. My experience is purely from a life insurance perspective. Most of the work that I've actually done is around actuarial valuations, but I have a bit of background in product development.
David?
Hi, everyone. Thank you so much for joining us. I hope you can hear me clearly. My name is David Limo. I work at Britam. Have around almost 10 years of experience in life insurance and also general insurance. And the last few years has always been interesting with the risk-based capital, and hence some of the discussions we're going to have today. So thank you so much.
Okay, thank you, Moses and David. I guess now it's over to you, Moses. You can start. I think you'll have to share.
Okay. I normally work from 2 screens, so I have to look for. Okay. So I hope everyone can see the presentation. So as said before, my name is Moses Mutuga, member of the Life Insurance Working Party. So the Life Insurance Working Party has been doing some work with regard to group benefits pricing. So what I'm going to do, I'm just going to take you through the framework itself that we've come up with. I'll also, in the process, just be explaining some of the illustrations that we've come up with, just more or less around to guide the industry around group life pricing. So as an introduction, if you think of just the benefits that are offered in the market around that more or less target groups, these come in various forms. You have the group life insurance. You have a few companies that are offering group critical illness solutions, all the way up to group credit and mortgage, as well as retrenchment cover. Now, these benefits target different individuals and more or less they have different risks. But some of the key issues that we've had around these products is more or less in the form of the way the pricing of these benefits are carried out. So what has happened is that the industry itself hasn't benefited in a way that it should if we were more or less to apply sound actuarial pricing practices. So the Life Insurance Working Party took it upon itself to come up with a framework where it would provide guidance to the industry in terms of what we think is the best way that the industry should go around pricing these products. So the framework that we came up with addresses two issues. The first key issue is the lack of data to price. As actuaries, I think we all know the importance of data in the work that we do. But when I think most of you can actually have experience, especially the ones who have experience in group life pricing, can tell you of how it's actually done. We typically don't have a lot of data to work with, and you more or less just have to apply a lot of judgment. So the first pain point that the framework more or less seeks to address is to come up with a minimum data requirement that will have to be provided for any group quote to be carried out. The second item is more or less the pricing process and the method in which we determine the price. So the idea is just to come up with some principles that should be applied in order to determine an actuarially sound quote. So looking at the first item around minimum data requirements, I think these things are more or less familiar to most of you, and they are generally the rating factors that you would expect to affect group business and group quotations. They range all the way from date of birth, gender, and some things that I know some of you may not typically work with. Things like occupation. On the group credit and mortgage side, in addition to having data of what is told to carry out a proper quotation, they would also need to have data on the loans themselves. You need to know how the loan is actually going to run off. You can come up with a proper price for such a quotation. So that's the first item on minimum data requirements. The second item is along the lines of the principles to be applied in the pricing of group benefits. So if you just think of, and the idea is just to come up with some principles. We don't want to be too prescriptive in terms of what actuaries can and cannot do. We want to come up with a framework that is principles based, where we provide guidance these are the things that actuaries should actually be on the lookout for when they're determining an actuarially sound quote. So we don't want to be too prescriptive in terms of what people should not do or should do. We still want actuaries to apply themselves. But then these are the key areas that we feel that in the process of you determining a quote, these are the things that you have to look out for. So looking at the first item is generally around how you determine risk premiums and the cost of claims. So the risk premiums can, you can determine risk premiums for different risk events. When it comes to group life quotations, you'll be carrying out quotations to cover death, PTD, disability, and various critical illnesses. So in order for you, so the first step in you determining a quotation is, first of all, you need to identify the risk events that will be covered in the quote. And then now you need to determine the various risk premiums for each of these risk events that you're going to quote. And what you're saying that in the process of now determining the risk premiums for each of those items, the items that you should look out for. So the first thing is that the risk premium should be sufficient to cover the cost of claims. Now, how you determine the cost of claims, it's the simple calculation of probability of event times the expected cost of the claim, or the average claim amount, or the sum assured. So that's the first step that you need to think about. The next thing is that the risk premium should reflect the risk experience for the group of lives to be covered. So that's, I don't know whether that's something that we all look out for, but ideally these are things that we should be on the lookout for. The third one is it should allow for the industry of the policyholders. So if you think about the different types of groups that we cover in group quotations, people working in white-collar jobs for financial institutions will not be exposed to the same risks as people working in a factory, because purely the nature of their jobs will expose them to different risks. The third item is around just having a minimum basis in terms of a minimum standard that we apply as actuaries in determining the cost of claims. And one other important one is that quotation should be done at a member level. Typically, what you'd find currently is that we are more or less given scheme summaries where you're told this is the total salary amount or the total sum assured, and you're told to determine this is, you need to come up with a quote for this. So ideally, what you're saying is that you need to have member level so that you can carry out quotations at a member level. The other thing is that you should have data on their ages and gender, and the risk premium should reflect this, because these are important rating factors. Now, for group credit business, you definitely need to apply some discounting, especially considering single premium business may be written for a long time, and over that duration, you will expect to invest the premium that you get and earn a bit of investment income. So these are things that you should look out for when you're determining the risk premiums. So the next item is around commissions and how you allow for this in pricing. So the pricing in the framework, what you're saying is that the pricing should adequately allow for the commissions that are going to be paid out. However, the commissions allowed for should only be should be capped at what can be paid out for that class of business, and that is found in the Insurance Act. If you actually pay anything higher than that, it means that someone actually needs to pay the additional amount, and most of the time it's actually the client who ends up paying that amount. So it could be considered unfair if you go ahead and charge a client anything above the regulated commission amount in the Insurance Act. The next item is around how you allow for expenses in pricing. So various companies will obviously have different expense experiences. We have different operations, and those operations will obviously cost, they'll cost different amounts. So ideally, what should happen is that an insurer should know their cost of acquisition and their cost of maintaining these policies on their book. So the pricing should allow adequately for the expenses that are going to be incurred in writing these schemes and the ongoing administration of these schemes. So obviously this now will be based on the different insurers and their experiences. The next item is on the profit margins. So what we're saying is that in the framework, we're saying in as much as insurance companies are writing this business, you should write this business with the objective of taking something back to your shareholders. So the premium that you're charging should make an acceptable contribution to the profit of the insurer. Now, as a life working party, we didn't want to specify what the proper profit margin should be, and this will obviously be dependent on the different insurers. Some companies may choose to have very high profit requirements, and some may choose not to have very high profit requirements. But one of the things that we're saying that you should consider is the cost of capital that you're going, that is going into supporting that particular line of business. If you think about the regulatory regime that you are currently operating in, risk-based capital more or less targets to charge capital based on the risk exposures that a company is exposed to. So if you as an insurer decide to take on more risky business, that should also come through in the margins that you're charging for that business. So essentially, the higher the risk that you take on, you should consider that the cost of capital will be higher, and also the resulting profit margin that you should be charging should reflect that risk. The next item is around reinsurance. There are various reinsurance options in the market, and depending on the option that a company may choose to go with, it will have a certain impact on their price. For example, if you decide to go into a quota share arrangement or a surplus arrangement where the premium basis is on a risk premium basis, so at that point, you'll more or less be using the reinsurer's rates more so than your own rates. So this should also come through in the pricing, considering the risk that you'll be taking on with regards to some of those schemes will be capped or will be shared in a certain proportion. So the insurance that you have in place should also come through in the pricing that you're going to charge for those schemes. The last item is on the free cover limit. And the free cover limit, what it does is it more or less interplays with anti-selection. So if you have a very high free cover limit, it means that you're more exposed to anti-selection, especially when it comes to group quotations, where you'll find that at the point when a decision is made, this information will be readily available, and they'll actually be making comparisons to find which is the best option for the client. And sometimes that means whoever has the highest free cover limit may be exposed to higher risk if their pricing does not more or less reflect this risk. So the higher the anti-selection, that should also come through in your pricing itself. The free cover limit should also vary depending on whether the schemes are mandatory or they're optional for certain people, because that also introduces anti-selection. If people have an option to join a scheme, you would expect that the people who are going to join are the ones who stand to benefit the most. So, and that can obviously bring in anti-selection. So the free cover limit is an important aspect that you need to consider at the point when you're carrying out these quotations. So in summary, the Life Working Party, we want to apply ourselves in a way that we want to see the market for group benefits grow. And the only way we can do that is if we apply sound actuarial pricing practices. We all know the importance of data. I think I find it strange that the line of business where we have the least or not the best quality of data is group business. You can hardly find data on dates of birth on any scheme. And this is an area where as actuaries we can provide a lot of value in terms of innovation and even providing better solutions to the end customer. And for you to do these things, you actually need to have the data to carry out these assessments. The other thing is that we just want to bring in a bit more. I think the number of actuaries in the Kenyan market are growing, and we need to get to a point where we start applying ourselves and the actuarial skills that we have. So this guideline is purely just meant to bring those things through in a way that will benefit the entire market. So So that's the end of the presentation on the group benefits framework. I'll be happy to take questions now. Joseph, should I take questions now or after you're done?
Yeah, good point. I think I suggested that questions can be taken at the end. I guess it's fine, you can take the questions, but we can have around at most 5 minutes for questions. And so if there are any questions beyond that 5 minutes, they can be shared with Moses or myself or John. So are there any questions?
There's also an option for the chat button.
Sorry, John, we didn't hear.
There is also an option for the chat button.
Okay.
I think I have one, and it's not just a question. So thanks, Moses and Joseph. And mine goes to the regulator. So it will be interesting, obviously, to just get the initial reaction from the regulator in terms of how this can actually be, how we can move it forward. Yeah.
Yeah, possibly, Joseph. I can comment also on that particular point. Yeah, so the intention actually is really to improve on the standards, yeah, of group life pricing, yeah, in Kenya. I think it is in an absolute mess at this time, and if no action is actually taken, yeah, then very likely, yeah, we will actually be held accountable at some point. So we will be offering a professional guide, yeah, to the different stakeholders of what we actually believe should actually be done, and it is through the work that has been done by the Life Working Party, yeah, that will be taking it forward. Yeah, so the intention actually is to actually engage the Association of Kenya Insurers, yeah, so that we can actually get their support on this matter. Yeah, because even if we get the guidelines actually approved by IRA, yeah, and it just happens that the insurance companies are not willing to adopt it, yeah, then it will be just work done in futility. Yeah, so it is very important that we get buy-in, yeah, from ACAA. Once we get that buy-in, then yeah, we are actually going to engage with the IRA and advise them that these are the proposed, yeah, guidelines, yeah, on how actuaries in Kenya should price their group life, yeah, group life schemes or policies, really. Yeah, so it is a process, yeah, but first we need to get, of course, the go ahead from yourselves as members of Task, then go to ACAA, then from ACAA, then we will actually be going to the regulator with the final, yeah, document. And the same will actually apply with the next paper that will be presented by David. Thank you.
Are there any more questions, comments? Okay, so please feel free to share any comments with myself, Moses, or John. We will keep everyone updated of the progress of this paper. And now it's time to hand over to David to talk about the loss absorbing capacity of deferred taxes. David? Thank you, Moses. Thanks a lot.
Okay. Thanks.
Hi, guys. I hope you can hear me.
We can hear you.
Okay, thank you. So thank you for joining us, and I also want to thank Moses for the presentation that he's taken us through. I hope you can see my slides.
Yes, we
Yes,
can.
the slide is visible.
Okay, so I will take you through the proposals we would want to take to the regulator on the loss absorbing capacity of deferred taxes and technical provisions on the risk-based capital. So in terms of content, take you through an introduction. We'll look at the loss absorbing capacity of deferred taxes. And then Joseph will take you through the loss absorbing capacity of technical provision. Then we'll do a summary and then field some questions. In terms of introduction, the current capital adequacy requirements, RBC, do not allow for loss absorbing capacity of deferred taxes and technical provisions. We don't know what was the reason for that omission, but given that some companies have huge deferred taxes and some companies are selling with profits policies, then it would be very important for us to take this proposal to the regulator so that we are in line with international best practice. We'll discuss how deferred taxes arise and how they can be utilized to absorb losses under stress scenarios, and then also we'll discuss how technical provisions for with profits businesses can be used to absorb losses under stressed conditions. Yeah, so I'll just give some background on what are deferred taxes, tax assets, and liabilities. So deferred taxes arise from temporary differences between what the accounting basis for preparation of financial statements and the tax basis. They normally arise because one basis may accelerate or delay the margins of profits or losses, and thus create a tax asset or a tax liability. So therefore, depending on where the company is making profits or losses, then the treatment of how you value your assets and liabilities between the two bases will create a deferred tax liability or a deferred tax asset. Examples include different depreciation rates used for accounting purposes, as opposed compared to the capital allowances that are used by the tax authorities. That always creates differences in the value of profits or losses, and hence deferred tax asset or deferred tax liability. And for the life companies, specifically in Kenya, deferred taxes arise because of the timing differences between when profits are made and when dividends are paid to shareholders. If you can remember, for those of us who've been in the industry for a while, prior to 2014, actually 2015, life insurance companies were not subject to corporate tax. Taxes was only paid when dividends are paid to shareholders. So the life fund was not subject to any taxation. So in around 2014, 2015 there, this was changed, and ISPAC gave guidance to the insurance industry to start taxing the surplus fund of all life insurance companies, and therefore created a deferred tax liability for most insurers that had a big surplus fund. So up to December 2019, deferred tax liability was not admissible when you are computing solvency. This was contained in Section 43 of the Insurance Act. And the Act specifically defined what admitted liability is, and they excluded the following liabilities. So liability in respect of share capital reserves in lieu of capital approved by the commissioner. Liability in respect for such other matters as the commissioner may, by notice, in writing, direct. The tax liability arising from unappropriated or undistributed surplus of the statutory fund, and such other liability as may be prescribed. So this section was repealed towards the end of last year, and thus deferred tax liability and all those other liabilities became admissible for calculating solvency purposes. So as task and through the Life Working Party, we had a deliberation on this, and therefore came up with proposals on how an alternative can be made in terms of how can we utilize these deferred taxes to absorb losses under stressed conditions, and also just to be in line with other solvency regimes, for example, Solvency II and the South African SAM principles. So just to give you an illustration of how the accounting balance sheet looks like and how the solvency balance sheet looks like. So your normal accounting balance sheet will have assets, and those assets will be represented by insurance liabilities. There could be other liabilities in there, and then there could be, because you're making profits, then there is a deferred tax liability, and then the balance of the life fund surplus. So the deferred tax liability is just 30% of the total surplus. And then if you go to your solvency balance sheet, some things happen. One is you have charges that reduce your value of assets. For example, 30% of your equities or property are marked down. So you're excluding them, so that reduces the values of your assets. And on the other side, you also have some margins. Margins, for example, for the valuation for insurance liabilities. An example is the 10% margin the 25 up or down shock on your valuation interest rate. There are charges on expenses and lapses. So all those lead to an increase in your insurance liabilities. So if you do that, what happens is your surplus reduces, and hence also your deferred tax liability also reduces. And in extreme cases, that deferred tax liability, your surplus can go to negative, hence creating a deferred tax asset. Yeah. So given that, and remember your deferred tax liability is a liability that is now admissible for solvency purposes. When you do those shocks, and we've seen that what happens is when you shock your balance sheet, your surplus reduces or can even go to negative, and hence your deferred tax liability can reduce or even extinguish and become a deferred tax asset. So this loss absorbing capacity is not allowed for under the current RBC rules, but it's part of international best practice. For example, Solvency II allows for it, SAM allows for it. So what we are proposing as task through the Life Working Party is to make some changes in the guidelines to allow for this loss absorbing capacity of the deferred tax liability by reducing the required capital that you've calculated by the 25% tax rate. But this should not be lower than the absolute minimum that is set in the regulations, or the percentage of business volume. It's only on the risk-based capital. So people who are assessed based on the risk-based capital model would benefit for this on this. So what the other thing if you're proposing is we should only allow we should not allow a deferred tax asset to apply. And for companies that would have a deferred tax asset apply, they should ensure that they are in compliance with the accounting rules on how to recognize a deferred tax asset. Yeah, I think that's the end of my presentation on how to allow for the loss absorbing capacity of deferred taxes. And maybe, I don't know, Joseph, do we have questions now or after the next section where you're going to take us through the loss absorbing capacity of technical provisions?
There are quite a number of questions. So my proposal is that I think there were 4 questions that were sent in advance. So my proposal is that we take the questions at the end.
Okay.
Okay, let me share my slides, so give me a minute. Can everyone see the slides?
Yes, we can see. Maybe you can just put it on presentation mode. Slideshow.
Hang on.
Yeah, you're good.
Okay. So I'll talk to you about the loss absorbing capacity of technical provisions. And in particular, I'm talking about with profit technical provisions for with profit business. So currently, there are no specific regulations on how to treat the loss absorbing capacity on with profits business. Remember that for with profits business, you are able to reduce or increase the bonus depending within bounds of your PPFM, which is your principles and practices of financial management, depending on your experience. In most cases, it's the investment return, whether it's high or low, but of course, experience on other assumptions. The actual experience will determine how much bonus you are able to pay out. So your technical provisions will include all the present values of the cash flows plus the risk margin. Now, the risk margin itself is the difference between your technical provisions and your best estimate liabilities. And the risk margin, by this I mean, if you look at the IRA guidelines, there are certain margins that you apply to your liability to come or to your reserves. So the sum total of those risk margins, of those margins. So you're allowed to reduce your benefits, taking into account management action to cushion yourself when the situation is tough. Now, so the loss absorbing capacity of technical provisions. So the value of technical provisions is normally shocked when determining the solvency capital requirements. The difference between the unstressed balance sheet values and the stressed values is used to build up the capital requirements. So each time you shock, you do a shock on your balance sheet values to get each capital requirement. Now with guaranteed benefits, each shock forces the company to set up capital, because with guaranteed benefits, the company has are not able to maneuver because they must pay what they promised the policyholder. However, for discretionary benefits, management are allowed to vary their bonus. And so this can take into account maybe drops in capital values. So what do we propose? So if you think about it, when you're calculating your RBC capital, you keep the values of discretionary benefits unchanged. So you're taking into account the bonus rates that you have set, and you do not shock them. You do not. You keep them unchanged, and you do not shock them when determining the base risk-based capital requirement. When calculating the solvency capital requirement, you actually would think, so if you think about it, first of all, you determine the future discretionary benefits by applying shock scenarios, allowing for any future management actions on future benefits. So you'd expect your discretionary benefits to be lower than booked on your base RBC capital requirements. So you determine, so what you do is you reduce the bonus rates. If you take the difference between your, so B, your base risk-based capital and your net risk-based capital, where you have allowed for reduction management actions, this will give you, this will give you, let's call it item B. Now, if you compare this value to your future discretionary benefits without a risk margin in relation to the future discretionary benefits and take the minimum, this is the adjustments we are talking about. So what you do is you calculate your base risk-based capital without management actions. Then you calculate your net risk-based capital by reducing the bonus rates and any other management actions, for example, market value reduction. You take the difference and compare that with your technical provisions where you have taken out the risk margin, but only in relation to future discretionary benefits. So this means that you'll have to look at your future discretionary benefits and strip out the risk margin for that. The adjustment that we are proposing is that you take the minimum of the difference of the base RBC requirement and the net RBC requirement, compare it with their future discretionary benefits, which don't have the risk margin. If that is negative, then take it to be 0. And this is the adjustment that you apply to your capital requirement. Of course, this makes sense only if your management actions have followed a certain structure and they are documented. Otherwise, companies would reduce their discretionary benefits to their own benefit. So remember that these discretionary benefits, and they are in quotes not totally discretionary because they are expectations for the policyholders. So number one, the assumptions for future management action should be realistic. In particular, those assumptions should be determined in an objective manner. The assumptions should be consistent with current practice and business strategy. So the future management action should be consistent with current business practice and business strategy. They should also be consistent with each other. So you can't apply, you should be consistent, for example, if you're applying management actions between lapsing and maturing. So try to be at least consistent. So the assumed management action should not also breach any obligations towards the policyholders, and they should also have been communicated to the policyholders. The management action should consider past experience, and they should also be approved by the board of directors and management. So they should be relevant to the valuation of the technical liabilities. They should be specific to the circumstances of the insurer, and the insurer should be can reasonably expect to carry them out. The order in which There should also be a description of any ongoing work required to ensure that the insurance company is able to carry out each of the respective future management actions. And finally, they should take into account the time needed to implement the management actions and any expenses caused by them. So for example, if you're implementing market value reduction, or you might have to communicate, it will take you time before you communicate. You have to do scenarios, so there'll be additional expenses that are incurred before you implement any of those. So basically, task proposes that for the loss absorbing capacity of deferred taxes and technical provisions to be determined, to be allowed for when determining the solvency ratio. And the main reasoning behind that is that these are in line with international best practice. So that brings me to the end of the presentation. We can now take questions. I can see there were like 5 questions shared on the deferred tax liability, the loss absorbing capacity. And I don't know whether John will read them out, or should I read them out and we answer them as we go along, and then we'll also answer any other questions. Okay, I'll read them out. The first question is, how do you calculate the adjustment for the loss absorbing capacity of deferred taxes when calculating the, okay, I would say risk-based capital based on the standard formula, or SCR based on the standard formula. But here in particular, we are referring to risk-based capital. David?
I think, thank you for that question. So what happens is, what Solvency II and some have taken approach is just to reduce your required capital, the risk-based required capital, not the minimum. If the minimum is, I think currently it's 400 million, you don't reduce that 400 million. It should not go below 400 million. You're only reducing the required capital that is calculated based on the standard formula, not the other 2 minimums, the 400 minimum of absolute minimum and the percentage of business volume. Those ones are not reduced. So in simple, let's say, for example, let's say your minimum, the 400 million is the minimum, and then you calculate your risk-based capital as, let's say, 1 billion. So what will happen is you reduce that 1 billion by the tax rate, which is currently at 25%, and then you set your risk-based capital to be 700 million. So that's how Solvency II and some have done it.
Thank you, David. I don't know the person who asked the question. I hope you're on the line. I hope you're satisfied. Okay, so the next question is, what models were used and what certainty did they provide? So I wonder whether this refers to, I wonder what that refers to. So if the person who asked this question is on the line, would you please clarify?
Maybe Joseph, if you can just try and answer it for both of them, for the deferred tax, and the technical provisions. So when we are doing it, we relied on, first of all, it's just common, I'd say, if you're just looking at it realistically, for example, for the technical provisions for with profits, if the performance is not, you remember you are declaring a bonus based on the assets that you've invested in. So if, for example, the current pandemic has happened, what will happen if now you expect lower investment returns, then you have leeway in reducing those future bonuses. So just trying to ensure that the capital requirements you're holding are, are very realistic. And then also for the deferred tax liabilities and assets, it's very intuitive. If you're making losses, then your values of your assets are lower. It means the accumulated surplus will reduce, and hence the future dividends you're going to pay out also reduces. So just trying to ensure that you have that fit. But in terms of the models that we've used, we've relied heavily on Solvency II and the South African SAM model.
Okay, so yeah, so thanks, David. For me, I think this question, it's a good question, but I don't know whether it was referring to even the group life presentation, or it was referring to deferred tax liability or technical provisions. So that was what we are trying to determine. So whoever asked it, please feel free to, if David has not answered your question, please feel free to contact us. We can elaborate further if you also referred to, if you are talking about group life. The next question is, what has created this need to have deferred taxes and technical provisions absorb losses? I think you answered that in your presentation, David. Unless there's another question. So the fourth question is effects of deferred taxes. So again, it's not clear what the question. So it just says effects of deferred taxes. Maybe what we can do is that whoever asked these questions, please, that question is, please contact us separately and then elaborate. Considering the solvency calculations are mainly considered on a wind-up basis, how practical will this be? I'll take an attempt. I mean, so by wind-up basis, my thoughts are that you're looking at a confidence interval rather than, so you can kind of say wind up, but you're looking at a certain confidence interval or confidence. You're looking at a 1 in 200 shock, or in a 1 in 20 shock. You can see Caleb. Caleb, you want to comment or? Okay, so in terms of their practicality, I think they should be generally simple to do, because all that you're doing is separating. So for example, with deferred taxes, I think that one, Limo can easily implement that one, or we can easily implement that one. And the one for technical provisions for with profits, all you just need to do is to get your risk margin to separate it out. Your risk margin that is specific to your future discretionary bonuses. I think they are very practical. I don't know, David, do you have any more comments or?
No, I think Joseph, you've captured it well. It's I think you've captured it well. I don't have any further comments.
Yeah, so about wind up, it's either, I think in Kenya, word was that it is a 1 in 20-year event, Solvency 2, and SAM is 1 in 200. So apart from those questions, are there any further questions? I can see we still have 5 minutes.
Joseph, Moses here, maybe just a quick comment on the loss absorbing capacity of technical provisions. Yeah, I think the governance behind it is very, very key. And you've actually mentioned of the document principles and practices of financial management, yeah, which kind of provides a very good framework to make sure that yeah, such allowances are not actually abused by management. Yeah, so I think one of the guiding principles, yeah, or the necessary document that will go hand in hand with that, yeah, that your working party should actually consider for future, yeah, is actually providing also a guideline, yeah, on the PPFM. I think that will be very, very important, yeah, so that we do not have actually having different companies, yeah, abusing, yeah, that particular allowance. Thank you.
Yeah, so thanks a lot, Moses. I think, yeah, the PPFM is important. There are so many with profits policies that are out there, and there's no PPFM. Even your typical deposit admin, where bonus is at the discretion of the company, and other business, I think it's important to put in your PPFM so that the practices are aligned with the policyholders' reasonable expectations, and the policyholders also have a document that they can refer to in case of any not issues, but any gray areas on how the returns they will get on their with profits business. Thanks a lot, Moses. Is there any other comment, question? Have any questions come through during the presentation, John?
No, I've not received any questions from anyone apart from what you just said.
Okay. Okay, so thanks a lot, everyone, for attending this presentation. Thanks, David, Moses Mutuga, and Moses Mutuli. Thank you, John, for organizing this webinar. Please feel you're all welcome to join the Life Working Party. Please contact us if you feel like joining us. Thanks a lot. I'll now hand over to maybe John to close off.
Thank you, guys. It's such a privilege for you guys to be here. We hope that you'll keep the engagement going. So thank you, Joseph. Thank you, David. Thank you, Moses. And thank you all.
I just got one request, John. People would like us to share the slides, so we can share the slides. I can see we have and I can also see that Elias has joined. So Elias is very senior in the regulator, and so he can also answer questions on how we will proceed. So we will be contacting Elias soon after taking the papers through ACAA. We will definitely share the slides and the papers, but now after this, the next step is to engage the relevant stakeholders, so that's ACAA and IRA, with our proposals. I don't know whether you want to say something, Elias.
I think this is a very good move for the profession, and ideally also in terms of building the insurance fraternity. One of the things that we usually give a lot of cognizance is the need of having professionals really helping the industry towards really implementing some of these initiatives. So I think task comes at a very important point in time whereby we are going to ensure that we develop solutions that will really enable us to ensure that each and every person or each and every company really is able to accept these particular items within the profession, and also ensure that they are in a position to comply with the requirements that we'll be issuing. So going forward, I think we should have these engagements also with the insurance companies. We need to start bringing in the CEOs, the board of directors, and also, as Moses have mentioned, one of the most important things that we need to really ensure that we appreciate is the need of governance. And governance can only be achieved by the top management really appreciating why these particular technical things or these IFRS 17 needs to be applied in the future. So let's also involve the board of directors, let's involve the management, because they are very key in towards implementing some of these solutions or some of these particular technical items that we need to implement. Thank you.